Okay, we're going to continue our look in Chapter 5 at leases by looking at Exercise 9 and a sales type lease. So remember, under direct financing, it's just as though we purchased it with an obligation and a receivable. That's still true here, but we've added one other piece if you remember back to intermediate, and that is the fact that under a sales type lease we've also had a sale. So you'll notice here on my screen I have the entries that we just did in the other example related to a direct financing lease, but then I also have the entries we did back in Chapter 4 related to an intercompany sale, because in essence a sales type lease means both things are occurring, so we have to do worksheet entries for both. So in this case we have a wholly owned subsidiary that is leasing an alignment machine, and the amortization table in this case we do not have to reconstruct because it's given in your book on page 304. So if we're doing these entries as of 12/31/11, then we know, just like in our prior example, that we would accrue what is going to be due at 1/1 the following day. So we want to take the $26.90 and eliminate that revenue and expense because it happened internally. Just like exercise 8 then, I'm going to pick up the obligation that is outstanding from the table. You'll see that as of 1/1/11, or right before 1/1/12, what's still due is $26,904. I have the current payable, and then I also have the remaining amounts in the table that are outstanding to give us the $47.90, and the minimum lease payments is again just like we did in the prior example. There's 4 remaining payments at $89.06, but then you'll notice that there's also a $2,000 amount that is a residual at the end. So our total minimum lease payments is $34,384. Then our CL3 is to simply reclass the item, and the total according to the table here and what's given in the text is 35, and the lease period or depreciation period in this case is 8 years. So we're going to take $43.75 each year, and that's our depreciation. So those are similar to exercise 8. Now we're into the sales portion of the lease, and if you look at it, there was a profit on the machine of $10,000. Well, we've got to take that profit out, just like we did in Chapter 4, and reduce the cost of the equipment for the $10,000. And then that also means that as a depreciable asset, we're going to amortize that profit over the remaining life, or adjust the depreciation if you liked that viewpoint. So our F2 entry is to adjust for that gain over the life at $12.50 in this case per year. And our last entry is an other. It's not really classified according to the scheming schedule that the authors use. But remember, we've got $1,000 going back and forth here for maintenance, and that again is intercompany, so it needs to be eliminated.